Welcome to Yahoo Finance Invest. The global economy is rapidly evolving from shifting monetary policy to inflation pressures and structural changes thanks to technology. In the backdrop, record-setting markets that are sparking fears of a correction or even worse. Joining me now is Mohamed El-Erian, Allianz Chief Economic Advisor. Mohamed, a real treat to have you here at Invest. Thank you for always making time for us. Let's start out of the block here on cockroaches. There's a lot of talk on Wall Street right now on cockroaches, and this essentially is risks coming out of various places, and it's hard to stop them. What say you? Where's the next, economic cockroach to be found?
So let me just say, we will have cockroaches, but not termites. And this is a fundamental differentiation. Cockroaches are unpleasant. They come in groups, but they don't eat away at the integrity of the system. Termites eat away at the integrity of the foundation. So why are we going to have cockroaches? We're coming from a period where people have stretched really far for additional returns. They have been encouraged to do so by a strong economy, by very loose financial conditions. And some people went beyond their comfort zone and beyond their ability to do due diligence. So I don't think we should be surprised that we will have these accidents, these credit accidents. We'll have some economic accidents, but I don't think we're going to have any systemic shock.
That is, of course, a good thing. And when you mention potential economic accidents, what keeps you up at night? Well, what are you most concerned about for 2026?
So what used to keep me up was a trade war, but the US has been able to impose higher tariffs without triggering much retaliation. So that doesn't keep me up as it used to. What does keep me up is what's happening at the lower ends of the income distribution for households, where there is significant pressure. And what keeps me up is the amount of debt that has to be refinanced at higher interest rates. So those two things are potential areas of pressure, which would be made worse if we get a policy mistake.
Mohamed, you bring up a really great point. It's something I've been thinking on very deeply of late. We've seen tremendous wealth created in the market this year, and the bull market has continued. But we're not seeing it, I guess this goes to your point, we're not seeing it translate into that average U.S. household, that lower income consumer. Is that cohort of the U.S., are they in a recession?
They're near recession, and they are spreading this concern about affordability, which is not just an economic issue, it's a social and political issue. The first shock to affordability was, of course, the 2021-2022 inflation shock. But that was offset, Brian, by income transfers. Now we have inflation stuck at 3%. We have insecurity about future income. The Challenger report showed you that layoffs were surging. AI will change the workplace. And in addition, we have high debt and credit cards that have been maxed out. So there is real concern on the bottom bit of what people call the K-shaped economy. And this is not isolated concern. If the lower household incomes stop spending, not because they don't want to spend, but they're not able to spend, that will contaminate upwards for the economy as a whole.
So you think that pressure on the low end, so the high income consumer, the person that is exposed to the markets, they've enjoyed a good year, they're not immune to what's happening on the low end.
So they're doing fine. They're doing fine from an income perspective. They're doing fine from a wealth perspective. So I'm not worried about middle to upper class. I am worried about lower income households and their ability to continue to navigate this uncertain environment.
How do we bridge this gap? Because if you listen to the current administration, Mohamed, they are talking, the president has floated a potential $2,000 dividend. There's been interest in that. The one big beautiful bill was passed. More jobs are being created in the U.S. in terms of tech companies building out AI data centers. Like, how do you bridge that gap between what's happening on the high end and low end?
So they also, you could have added to that list that they've moved on some very sensitive prices, gasoline being one, and the other one being some pharmaceuticals. So they are taking steps, Brian, but this has been long in the making. This is not something that is recent. and therefore it is deep-rooted. It is made more complex by two other issues. One is the difference between real and perceived, and the other one is the difference between relative and absolute. So it is a really complicated issue, and if you go through it, the bottom line is it will take years of effort, both on the income side and the price side, to get us out of these situations.
I want to leave enough time in this conversation, Mohamed, because you are known as a foremost thinker on Federal Reserve policy. It has been quite the year for all things Federal Reserve, of course. Attacks on the Trump administration. We're coming up on the end of Chair Powell's tenure. Where is your head at as it pertains to the Fed in 2026? What is a new Fed chair? What will they bring? And where do you see the ultimate endgame for rate cuts this cycle?
What a new chair will inherit is a divided Fed. And it's divided by two things. One is whether they are sensitive to the employment side of the dual mandate or to the inflation side of the dual mandate. Both are flashing yellow right now. So it does matter where your bias is. And what we see is that people are on both sides of this divide. The second thing that they will inherit is a division between people who are totally comfortable being backward-looking, so-called data-dependent, and those who realize they also need to be forward-looking. They need to have a strategic view of the economy, and in particular, Brian, of something you've been talking about a lot, AI and its impact on productivity and growth. So what a new chair has to bring is a unifying narrative. And I think that narrative has to be forward-looking. And the new chair has to have a view as to what the future economy looks like. I am a great believer, as you know, in the promise of AI. If we get diffusion right, we will have a significant productivity increase. And as a result, monetary policy will be able to be looser than it would otherwise have been.
Do you view the attacks on the Fed and what it does for the administration, will that leave lasting damage on this institution? And if you do think that's the case, what does that damage even mean to markets?
So I believe deeply in the independence of the Fed, deeply, that I think a Fed with policy autonomy is the best thing we can have. But I also believe, as you know, that this Fed went to sleep. There are many areas of reform that require attention. There are many best practices that from the rest of the world that we should be looking at more seriously. And there's lots of hard questions that we need to ask, including what is the right inflation target in a structurally changing economy. So the good news is you're starting to hear debate from within the Fed. You've had two federal officials, as you know, come out and saying, maybe we should have a range for inflation, our inflation target, not a point estimate. You've had another one come up saying we target the wrong intermediate policy variable. So I'm encouraged by the fact that the Fed itself is now finally talking about reforms. And that is something that, if you look at the 5 candidates on the short list, all of them understand that you need to reform the way the Fed operates. Otherwise, the Fed will continue to be behind. And if you look at the recent years, not only have we had decisions that were too late, but we've had a culture issue. We've had 5 officials that were accused of irregularities. So I think it's really important to reform this Fed. And what this political pressure has done is it has made certain Fed officials realize that it's better to reform from the inside than to have it imposed on you.
The 5 contenders you mentioned on the short list for the next Fed chair, do you have confidence that they will keep the Fed independent?
I do. I think all of them understand the history of central banking. They understand the importance of keeping the Fed independent, but they also understand that an independent Fed needs to be an accountable Fed, and an independent Fed needs to reform itself to keep up with changes. It is striking to me, Brian, that we don't have external members serving on the FOMC, like the Bank of England does. So we end up with groupthink, and that groupthink ends up by the Fed being behind. We saw that in 2021, 22, and we've seen it again this year. So there are things that can be done and should be done. And I think that all 5 realize that an independent Fed is critical, but it doesn't mean a Fed that goes to sleep on how it operates.
Do you think the 2% inflation target should be scrapped?
I don't think it should be scrapped. I think it should be changed. I have been of the view that a better inflation target is a range, not a point estimate. A point estimate suggests precision that is elusive. Second, that range should be higher than 2%. It should be the 2.5% to 3%. And what is undeniable is that we are at a stable 3% inflation, and that hasn't in any way unanchored inflation expectations.
Out of the 5 candidates, Mohamed, look, I agree with you. These are incredibly qualified people. Of course, shout out Rick Rieder, friend of Yahoo Finance. We all know him very well. What do you think their biggest problem they will have to solve? That first 6 months on the job of leading the Federal Reserve after a long tenure like Jerome Powell has had, like, what do they need to get right out of the box?
Shifting the Fed from an excessively data-dependent, backward-looking institution that is reactive to one that has the confidence to take a strategic view and be proactive. That's going to be a major change that is really needed, has been needed for a while, and that hasn't happened under Chair Powell.
I wanted to get back to what you mentioned on AI and productivity. You could see AI chatbots, at least for now, this current wave of innovation is already starting to drive a lot of productivity. How much of a risk is it to jobs around the world? How concerned are you?
I'm concerned mainly because of the corporate mindset, Brian. If you look at the promise of AI, there is a labor displacement risk, and there's a massive labor enhancing opportunity. And the worry I have that with the exception of a few companies, the mindset right now in corporate America is about cost minimization. AI is viewed as a cost minimizer. What AI really is an enabler, a productivity enabler that gets there from better work and more work. And I worry a little bit that the mindset is too focused right now on cost minimization, because the real promise of AI is not labor displacement, it's labor enhancement.
I told myself coming into this, Mohamed, I didn't want to be that guy that asked you about a bubble. I just think it doesn't capture the nuances it deserves. So let me, if I can frame it a little more academically, how concerned are you that AI stocks are grossly overvalued?
So let me share the work that I've been doing with Mike Spence, a friend and a Nobel Prize winner. We believe that we are in a rational bubble. So yes, there are elements of a bubble. And there's 3 elements in particular of this bubble. First, the frontier, those working on foundational models. Not all of them are going to succeed. And yet all of them are attracting significant investment. Second, diffusion isn't being talked about enough. Diffusion means getting AI into the workplace in an orderly fashion, in a comprehensive fashion. We don't have a diffusion policy so far. Other countries, China does, UAE does, we haven't. We've got to get diffusion right. Otherwise, the promise of AI is not going to be fully realized. And then you and I remember the dot-com era. We remember companies simply putting a label on what they do and attracting investment. Well, that label today is AI. So there are elements of a bubble, which means that people will end up with losses. But the aggregate value of what's being created is significant. And therefore, the rationality part comes in, Brian. It makes sense to take a venture capital approach to AI. The payoff is so large that it is rational to have multiple investments and to overinvest. So the good news is that it's a construct that will make us more innovative, more competitive. The bad news is there will be tears, there will be losses, because elements of it are elements of a bubble.
I wanted to leave Invest viewers thinking with one deep thought. And let me come at you with this question, Mohamed, before we get going here. If you were writing a short message to policymakers right now, one key action they should take, what would it be and why?
That realize that our future is going to be at the tails of distribution, not in the belly. You know, for a long time, we grew up with unifying themes, the Washington Consensus, globalization. We are now living in a world of fragmentation, in a world that structurally changes. And what happens at the tails are going to determine where we end up. So don't get fooled by a normal distribution, a bell-shaped distribution. Realize we're in a multimodal world.
Always a treat to get some time with you. I always enjoy our conversations. Mohamed El-Erian, Allianz Chief Economic Advisor. We'll talk to you soon. Thanks for joining us here at Invest. We appreciate it.
Thank you.
Markets are continuing to price in an interest rate cut in December. That's despite Federal Reserve Chair Jerome Powell's recent hawkish comments, saying another cut this year is not a foregone conclusion. And it's not just rate cuts that have all eyes on the Fed this year. Investors are also waiting to see who will become the next Fed chair and what the future of Fed independence will look like due to ongoing pressure from President Trump. Joining me now at Invest is Lael Brainard, former Federal Reserve Vice Chair, former Undersecretary of the U.S. Department of Treasury, and former Director of the National Economic Council under President Joe Biden. Lael, always a treat to get some time with you. I thank you for coming to Invest. The debate right now in markets, the day after the government shutdown has officially ended, is the lack of data. And the Trump administration has locked in on the fact that we may not get this data from the past few months. How concerned are you about the lack of economic data that's likely to come out?
Well, it is a very unusual juncture. Going into the December meeting, it's just much less clear where the Fed is going to go than it was back in September. And it's not primarily because of the lack of data, although the lack of data just makes it worse. It is because we have heard from both sides of the Monetary Policy Committee that both the hawks and the doves are digging in, with the hawks saying that inflation is 3%. It has been for 44 months now. And it is projected to remain in that territory because of the tariffs. On the other side, the doves are saying that the labor market appears to have softened given the last public sector data that they have, as well as some private sector data. And both sides are right.
Before the government shutdown, Lael, there was a general consensus that the economy was slowing down, as seen through the prism of U.S. labor market data. Why was that happening?
So I think we have a very clear two-track economy. We have the AI sector, and all of the related sectors are seeing record interest in the stock market, are seeing massive investments, data centers, electricity, chips. The leading sector is doing extremely well, but it's not hiring. And the rest of the economy is suffering. It's suffering because it is less favored in the capital markets. It's suffering because it is still trying to digest those tariffs. And then it's also, a lot of those businesses are not clear how much should they hire given what they're hearing about integrating AI into their businesses. So for all those reasons, neither the booming sector nor the remainder of the economy are really hiring. And meanwhile, you have very divergent economies.
Is the economy in a recession?
I would say you saw the second quarter growth number coming in very strong, 3.8%. Consumers remain resilient. Now, we know that that is the top of the consumer income distribution, but they do remain resilient, driving spending. And all the estimates are that third quarter GDP is going to come in quite similar. So the economy at the top level is strong, but again, it's being driven by this really important set of investments in AI. The rest of the economy under the hood is really stuck.
You bring up a good point, Lael. Why do you think the wealth we're seeing built at the top end, as seen through the prism, of course, of the stock market, why isn't that trickling down to the average household?
So you saw it in the election. Clearly, people in the lower half, even the lower 3/4 of the income distribution, are really concerned about affordability. They've seen prices of coffee and bananas going up, housing costs not coming down, utilities costs going up. So they're very worried about that, and they're worried that their job opportunities are not as good as they were a year or 2 years ago. You see that in the consumer sentiment surveys. Whereas that top 10% of consumers, their housing, values have gone up, and of course their stock portfolios are very positive.
I'm glad you mentioned coffee and bananas, Lael, because the Treasury Secretary, Scott Bessent, is out this week saying the administration plans to put policies in place to bring prices down for coffee and bananas. Maybe this is the new egg debate. Whatever the case is, you're in government. Can the administration actually do this? Can they bring these prices down for these two key ingredients?
So, look, I think it is interesting, first of all, to see the Secretary of the Treasury and the administration wake up to the fact that people are really unhappy about prices and affordability. Don't forget, just a few months ago when they were putting tariffs in place, he was talking about how, well, there'll just be fewer toys under the Christmas tree come Christmas time. Now, I think they're seeing that actually consumers are really troubled by this affordability. And to some degree, they can take tariffs off where they've put them on. And that is what they're talking about. But it will be very difficult for them to fundamentally reverse the affordability crisis in areas like housing and, of course, in healthcare because of some of the expiration of the tax credits. It's actually going to get worse for millions of families.
Do you believe the higher prices we have seen, coffee, bananas, whatever it is, furniture, apparel, are tariffs causing this inflation? And then do you think the administration will come to regret these tariffs?
So, look, I think in areas like baby clothes and strollers and toys, furniture, those are clearly tariff related. You can see the tariff lines. Coffee, bananas are hurt by tariffs, but in some cases there are structural forces that are making these worse. And so, for instance, the demand for electricity is growing at a rate we haven't seen in many years because of the boom in AI, and that is inevitably going to put pressure on consumer electricity prices. And that is something that is more complicated and difficult for the administration to reverse. Of course, it didn't help that they got rid of a lot of the alternative energy incentives. They have brought prices down. We're seeing lower prices at the pump by a little bit. But some of these other forces are going to be difficult for them to reverse without reversing their own policies.
I talked to a noted economist, Lael, Mohamed El-Erian, earlier on at our Invest event. He said this, quote, "I believe that this Fed went to sleep." And Mohamed was referencing that the pressure, like you were mentioning too, on lower income consumers. Is the reality that the Fed, that meeting, December 10th, decision day, they need to come out here and cut rates and make it clear that more rate cuts might be needed to ease the pressure on households?
Well, I think they are in a difficult spot because they have the most powerful inflation fighting tool. And of course, with inflation now not continuing to come down, but stalling out around 3%, a little higher, they are concerned about inflation. I think most members of the committee believe that this is a transitory impact. They don't like to use that word, but they do expect the tariff effects to dissipate, so no further increases from tariffs eventually. And the other side of the committee, I think, has been sounding the alarm about the weakening labor market. And that was what we saw in September, very clear commitment to cut 3 times in those projections. But it turns out that 9 of the 19 members were not actually on board for 3 cuts. And so that is what we're going to see play out in December. Even if we see a cut in December, it's likely we would see a pause after that, given where the hawks are on the committee.
If you were still in the Fed, Lael, would you argue for a rate cut?
I would. I would be concerned about the weakening labor market. And I think I would take the risk that perhaps tariffs push prices higher for a little longer against the risk that we really see a self-reinforcing downturn in the business sector that leads to real pain for American households. So weighing those two risks, I think as many members of the committee, including the chair, has articulated, they are more concerned about the risk to the downside on the labor market. We just heard that again from Governor Cook. And they're willing to take a little bit more risk on the inflation side of the mandate.
That decision on rates, Lael, is just, of course, one day on the calendar. You look out through this whole year, and it comes against a backdrop of really unprecedented attacks on the Federal Reserve by President Trump and various members of his administration. Are you concerned that these attacks have undermined the credibility of the Fed longer term?
I am very concerned. I think everybody should be concerned because, of course, the Federal Reserve's independence is what is key to its credibility on inflation fighting. And the fact that most people believe that they will bring inflation back down to 2%, that inflation expectations are well anchored, is rooted in that independence of the Federal Reserve. So we've seen, as you said, unprecedented moves to fire a board member without cause. We have seen another new board member appointed while remaining on the staff of the president's office, and ongoing statements from the administration that they believe that the Federal Reserve needs to lower rates in part to bring debt service on the national debt down, which of course is a real violation of Federal Reserve independence if it were to happen. So for all those reasons, I think investors and the public should be carefully watching what happens over the next few months in terms of the Supreme Court case on the firing of the governor without cause, as well as the appointment of a new chair and what that signals.
Of course, the list to replace Chair Powell next year down to 5. Are you confident in these 5 choices?
So the lists that people have talked about publicly, they are all highly qualified individuals. And the real question is the extent to which each of them can truly be independent of the White House and be perceived to be independent, because at the end of the day, it is that public perception that the Fed truly is independent and makes its own calls based on its dual mandate, which is to keep inflation low, keep the economy at full employment. That is what anchors inflation expectations, and it makes it easier to bring inflation to the 2% target without causing unemployment to rise.
Lael, before I let you go, Chair Powell, he's been a constant in markets for years now. What do you think his legacy will be?
Well, I do believe that the single most important legacy will be his very determined efforts to guard the independence of the Federal Reserve, to make sure that the Federal Reserve maintains its institutional strength and resilience. And of course, that is the most important legacy he can hand to future Federal Reserve chairs. It's also the most important legacy to serve the American public, because it means that they can have confidence in low inflation and that it won't require high unemployment to bring inflation down.
Our next guest's career in financial services has spanned 4 decades, and she's appeared regularly on lists like Barron's Most Influential Women in U.S. Finance. I'm joined at Invest by Ann Walsh, Managing Partner of Guggenheim Partners and the Chief Investment Officer of Guggenheim Partners Investment Management, which oversees more than $350 billion in assets. Ann, thanks for being here.
Hey, Julie, nice to be here.
So it has been a really interesting market environment. I guess maybe we live in interesting times, as the proverb goes. And I know one of the more recent things that we've been watching in the market here has been the government shutdown, and now the end of the government shutdown. And it was interesting because the shutdown happening didn't really seem to harm the rally in the equity markets, but there did seem to be a little relief when it was over. I mean, how did you think about the shutdown? And more broadly, how do you think about government functionality as it relates to investing?
So we've certainly seen now a record-setting government shutdown, but we saw the second longest during the Trump 1.0 administration. And I think this fiscal policy and political disruption is really one for the playbooks for the rest of the Trump administration. And the volatility ride, I think, will continue from that perspective. Having said that, I think that we are through some portion of some of the volatility that we saw earlier in the year. I like to think of the Trump administration of having 4 policy pillars in no particular order. Trade and tariffs, which continues. Deregulation, which is sort of going on in the background right now with great pomp and circumstance to begin with DOGE, but really kind of now playing around in the background. Tax policy, which is one of the elements that's actually got some certainty to it now because of the One Big Beautiful Bill passage, and I think that's going to create some tailwinds into 2026. And then ultimately the immigration policy, or if I tend to prefer to call it reverse immigration. So we're seeing all of this play out, and I think that's going to continue.
Do you think that it is all of this is at this point an underappreciated risk by the market? The market seems to have gotten somewhat used to some of this. And again, more broadly, do you think that the political gulf in this country is an underappreciated risk by the market?
Well, I think we have to sort of separate markets from politics and policy, and obviously, and even the real economy. They have combined effect, but they're operating in almost a siloed fashion. The disparity or the discourse with regard to policy and politics, that's going to continue, and that's going to create headline volatility. But I think the market's looking through that, whether you're talking about fixed income markets or you're looking at equity markets in particular, you're looking at Fed policy. Markets are considering a whole lot more factors, and they're looking at the fundamentals separate from the narrative that we see at the headline level.
All right, so let's talk about some of those fundamentals then, and let's start with the Federal Reserve. Now, earlier today, we here at Yahoo Finance Invest heard from the former Fed Vice Chair Lael Brainard, and she talked about the challenge that is right now before the Fed. So I want you to listen to what she had to say, and then we'll talk about it.
With inflation now not continuing to come down, but stalling out around 3%, a little higher, they are concerned about inflation. And the other side of the committee, I think, has been sounding the alarm about the weakening labor market. And that was what we saw in September, very clear commitment to cut 3 times in those projections. But it turns out that 9 of the 19 members were not actually on board for 3 cuts. And so that is what we're going to see play out in December. Even if we see a cut in December, it's likely we would see a pause after that.
And it's interesting because at the same time, she said she would vote in favor of a cut in December because she is more worried about the labor market. What do you think is going to happen here with rates?
So we're at kind of a delicate time because we have had the government shutdown. We don't have the usual data sources for the Fed to point to, and they like to claim to be data dependent. Having said so, they also look very much at anecdotal evidence, and in particular the Fed's Beige Book, which seems to indicate a slowing down of the economy to a level that I consider more equilibrium. And if we're in more of an equilibrium, which is a sub 2% real rate of growth, then I'm looking at real rates of interest that should be lower. The neutral rate should be lower. And so let's just assume the neutral rate's a 3% level. So for the Fed to continue to cut rates to 3%, they have some more cutting to do. I'm in the camp that I believe that they actually will cut in December because I look at that Fed Beige Book and it seems to indicate a lot more slowing and fraying around the edges in particular. One area that we've watched all year long and will continue to watch is sort of what I call the bifurcated economy. Right. There's really 2 speeds that are happening in the U.S. economy. One is the lower end consumer and the small business market, and the other is the high-end consumer and the larger companies with access to capital and the ability to, particularly benefit from the AI trade, for example. And so as a result, you've had this 2-speed economy, and the Beige Book really represents this broader level of the economy, and it's really becoming much more sluggish. And so as a result, I think ultimately the Fed will say neutral's probably lower than it is now, probably closer to 3%. And, the idea of actually cutting rates makes sense. And I still also contend that we're going to see more rate cutting in 2026 as well.
And you think that the sluggishness in the economy will take care of the inflation issue? Because that hasn't gone away.
Right. Well, one of the other elements about this bifurcated economy, of course, is that portions of the economy that are particularly sensitive to interest rates. So the interest-sensitive parts of the economy are also slowing down, housing in particular. And the cost of housing is actually declining, although that's not much reported. The last CPI number, the one that we actually got to see, seemed to finally indicate the owner equivalent rent portion of CPI had finally started to move down. And I think that's going to make a big difference. So while I believe that the rate of disinflation has slowed, the trend is still towards more disinflation, which will then also be supportive of further rate cuts.
I also wanted to ask you about the composition of the Federal Reserve. As we know, and as Lael Brainard just alluded to, it's a very divided Fed right now. But we're also going to, of course, get a change in leadership at the Fed next year. And the White House's sort of rhetoric about the Fed has faded to some extent. But who do you think is the best choice to lead the FOMC next? And are you concerned about the White House sort of, again, leaning on that person when it comes to policy decisions?
Well, a few ways to look at the selection process. One, I think that the panel of nominees that are being considered are all pretty well qualified to be Fed chair. I have my particular favorites, but
you want to tell us who they are?
Well, I actually happen to be a big fan of Kevin Walsh. And I'm biased because he's a bit more of a monetarist, and I do believe money supply still matters. But Mickey Bowman's amazing, and maybe more of a dark horse is Kevin Hassett, and then I'm a big fan of Chris Waller as well. So we have a good selection of potential candidates, and notice I sort of picked more of the economist background personalities, if you will. Having said so, I believe ultimately it's not the first time we've seen political pressure put on Fed chairs. We go back to Nixon, we go back to Lyndon Johnson. There's a long history of presidents trying to put pressure on the Fed chair, and strong Fed chairs are important. Independence is important, but let's remember the Fed's also subject to congressional oversight, so not fully independent from policy oversight. They have two mandates. The dual mandate of stable employment and stable prices is still part of what they're obligated to work towards and engineer. Having said all of that, no matter what happens, I think we are looking at a more dovish Fed composition, and that means we're back to my concept of and belief in much lower neutral rate going forward, which should be helpful for the interest-sensitive part of the economy, the lower-end consumer to some level. For example, along with, in 2026, some tailwinds that we're going to have, particularly with the One Big Beautiful Bill. There's some tax benefits in there that will also be rather stimulative. So I think all of this keeps us out of any kind of recession risk, but it lends us to more of a neutral policy.
I wanted to come back to the other big driving engine in this economy, and that's AI, of course, which you and I have talked about before. How are you thinking about this whole bubble question and how to strategically invest in AI right now? So I'm a big fan of technology in the long run, and I believe artificial intelligence will ultimately be a technological game changer. But it has to play out. We're still in early innings. The huge amount of investment that's being undertaken right now is in the blocking and tackling, the chips, the infrastructure build out, the data centers, and ultimately the power needed to power all of this into the future. The applications, the work streams, the usage of AI has to broaden out into the entire economy, and that's going to take some time. So in the long run, I'm also very positive. In the short run, in terms of just equity valuations, the question is, are we in a bubble? And I think if you look back to the number one comparison time frame, which was the internet bubble in late 1990s,
you were looking at valuations that were so extreme because you didn't really have any earnings. Now you have earnings, and I think the risk or the concern is, are we going to now pile on quite a bit of debt to build out the infrastructure for artificial intelligence into the future? And I think that's something to watch, but I don't believe that we're there at this point in time. I think there's more for this market to run, and I think technology will continue to drive a lot of stock market performance.
So on the corporate lending side, you don't yet see, or maybe we won't see, that sort of reach for risk in terms of this build out. What kind of warning signs would you be, as someone who is very experienced in the credit markets, what would you be looking for?
So I get asked this question a lot, particularly with regard to private credit,
Yeah.
which is, where are we in the cycle?
Yeah.
And what I say is there's cyclical risk, and then there's structural. And cyclical risk is what happens late cycle in the economy, when the economy slows down, there's more bankruptcies due to businesses failing, usually recessionary pressures. We're late cycle, but we're not really there in a recessionary environment. Structural happens when you end up with over leverage, too much lending to over levered entities.
Like the financial crisis.
Exactly. And you also end up with weakened covenants, investor protections go away. And when you get a few headlines like, Tricolor, for example, or First Brands, you get people questioning, are we having structural risk, or is this still cyclical? And I would say it's still more a little bit cyclical, as those particular companies tend to start to have problems late cycle. So, but we don't have what I consider to be, at this point in time, a structural, widespread risk, and I'll say yet. But that's what I look for and what I'll look for in the future.
And you have a great analogy to explain at these cyclical times when people reach more for risk. You have an analogy that explains sort of the risk that maybe they're taking in offering some of these loans.
Well, I think actually what ends up happening is people don't examine where the collateral is, what the underlying value is. And my analogy, it's a little rough, but you can take a Tiffany's box, and it's beautiful and it's gorgeous and they put a pretty bow on it, but if you fill it with dirt, there's no diamond ring inside. It's just a box with dirt in it. And I think that's what lenders and investors have to be aware of, is know what you're investing in. And do more than just look at the outside and assume that everything is okay. Really do the diligence. Select your asset manager carefully, and that you know that they're doing their diligence.
Right. Do the work. That's always good.
Work.
That's always good advice. I want to end on this, Anne. Obviously, you work really hard. Every time I see you, you're traveling around, speaking to investors, working with portfolios. What do you do when you're not doing this? What do you do to relax?
Well, I read a lot,
Yeah.
and actually, I do get to play some golf. So I get to spend time with my family, and we're all golfers, and it's a good way to come together and enjoy a beautiful afternoon. So yes, there actually is from time to time some downtime.
I like it. All right, good. Thank you so much, Anne. Great to see you.
Thank you, Julie. Nice to see you.